Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Right, so in terms of the lights, make it medium. Right. Okay. So we had a couple of slides to finish from last time, and it's not going to take long because probably there's only one point that I would expect you to know for exam purposes, but so it's more sort of for your information, for your knowledge. I'll mention the point that I really do want you to know. So here we're looking at, in the last couple of slides, the interaction of domestic tax systems. That's what I've called the title to this heading. I had a different heading in the previous semester, but I think that's really what we're talking about, right? When we are considering the prospect of a double taxation issue, it arises because the countries of the world, most countries of the world, have legislation that imposes taxation on people. And what happens when a person potentially faces a tax liability in two countries in respect of the same income? Okay. How do we address that? Well, there are mechanisms to avoid double taxation. They exist. Actually, I think that the primary protection against that is in domestic law itself. So if we're looking at the Australian tax legislation, it's Division 770, the foreign tax offset. And that's the thing I want you to know, which is in a later slide. So there are double tax treaties or double tax agreements, DTAs for short, which also are one of their purposes, perhaps a principal purpose, is to avoid double taxation. But since I've been thinking more deeply about the issue in the last couple of months, I think perhaps we're placing too much emphasis on double tax agreements in relation to the double tax point, because there is the protection in the Income Tax Assessment Act itself. So, and if you look at the double tax agreements and what they're trying to achieve, and what I did have a look at in the last couple of months is the Australia-UK double tax treaty or double tax agreement, is, well, they allocate taxing rights. But the thing is, and this is the point I made on the slide, and it's a new point, so it's not in last semester's slides, right, since I've been thinking about it more, is that with these, they take the position that tax may be charged by both countries with respect to various kinds of income, right? So, and that's the case with the Australia-UK tax treaty. With the articles, and it's really quite a short agreement. These treaties are, these double tax treaties, they go through various kinds of income, could be employment income, income on the alienation of property, which is really to do with taxation of capital gains. And most of the time, and this goes with dividend, interest, royalty income as well, mostly it's saying both Australia and UK can tax the income, right? So where's the protection with respect to double taxation? It's actually through domestic law, right? The foreign tax offset. And it's a thought that occurred to me with tax offsets in domestic legislation is, well, both countries couldn't be giving a tax offset, right? Because that could lead to a problem of double non-taxation. Well, but then I think that the usual, how it happens in practice is that, in terms of how the laws are structured, is that the country of residence of a person usually grants the tax offset. That's how it works, okay? Look, this is a for your information slide, just giving you a feel for it, the flavour of it, that we do have these double tax agreements. As I said, mostly they say that both countries can exercise taxing rights, right? Both the country of residence of the person and the country of source, right? And in terms of determining country of residence for the purposes of tax treaties, they do provide for a definition of residence. It's where your permanent home is, and if you have a permanent home in two countries, it provides for for tiebreakers. You know, then it goes to, well, what's the country where you've got closer personal or economic ties? Now, just a sec. Ah, well, that's good that that worked, because the arrow on the computer didn't work in terms of changing the slide. So the point I want you to know, and I think I've really talked already about that first, or well, to some extent, really what that first paragraph is talking about is how can you have a double tax problem? Well, the problem can happen when you are resident of, say, you're a resident of Australia for tax purposes, but then you go overseas for a period in circumstances where you are still a resident of Australia, okay? Your residency hasn't changed, okay? And you earn some income, and that other country, you know, is wanting to tax you on your income for services based on source, right? So then you've got a double tax issue. Australia is trying to tax you based on residence, that other country is trying to tax you based on the source of income. How do we deal with it? Well, in some cases it's possible that the double tax treaty resolves the issue. In general, it does not actually, despite all the emphasis placed on double tax treaties as a means of avoiding double taxation. How it's resolved is, in Australia, it's through tax credits for foreign tax paid. Okay? That is the main mechanism, right? It's tax exemptions, it's so narrow where they apply these days in the law. It's really tax credits. So in that situation I gave you, where you've got an Australian resident, they earn some income overseas and it's taxed overseas, well, what that person would do is that when they're completing their Australian tax return, right, they're going to be liable for the overseas income, subject to Australian tax, right, because the assumption basis here is they're a resident, okay, but they can claim a credit, an offset for the foreign tax paid, okay, so they will not be double taxation. And the provision in the law which gives a person an entitlement to that foreign tax credit or offset, they mean the same thing, credits and offsets, is Division 770 of the 97 Act. So that's the provision I would expect you to know for exam purposes. And it is also in your tutorial solutions for this coming, the tutorial that we've had on residency. I do mention it there as well. Now, as I said, exemptions hardly ever used in the law. By an exemption, right, theoretically, I mean that is a way of avoiding double taxation, but it's very narrow where it applies anymore. So how an exemption works is it's where the law says, well, if you earn income in another country and it's taxed in that other country, it's exempt from tax in Australia. Okay, that's how an exemption works, right? No tax applicable in Australia, right? Very rare these days to get exemptions, okay? One very narrow exemption that exists in the law, 23AG of the 36 Act, which is for the benefit of a very narrow class of people, for people working in charities and non-government organisations, right, where they have worked overseas for a period not less than 91 days, so at least 91 days, the income they earn is exempt from tax in Australia. Okay. The one I want you to know is 770. Okay. Okay, shall we please go to our income slides now? So we're going to a different topic, new topic, assessable income. So this is really critical. I mean, residency and source was really critical and fundamental, right? This is too. Pretty much, I think the topics, most of the topics we do before the break are really critical and fundamental to your understanding of all of income tax law. So we're looking at what is income for tax purposes, right? Let's think about it in terms of the tax formula. What do we pay tax on? We pay tax on our taxable income, right? And what is taxable income? It's assessable income minus allowable deductions. So here what we're looking at is that critical input into the taxable income formula, which is assessable income. Some of this we touched on briefly in week 1 because it's so important. So assessable income, right, under the income tax legislation, it is comprised of what we call ordinary income and statutory income. And in fact, Section 611 of the 97 Act says that, right? Assessable income is ordinary income and statutory income. We will spend more time on ordinary income, right? And it makes sense to spend more time on it, not only because I think it's more conceptual, right? And there's a lot more learning, right, in terms of cases on ordinary income. But that's not the only reason. There's a real logical reason why you spend more time on ordinary income. How the law is structured is, if a receipt is ordinary income, you don't ask, is it statutory income? And you don't go straight to considering whether it's statutory income, right? So the analysis under the law is you consider whether it's ordinary income. It's only if you have doubts as to whether it's ordinary income or it's not ordinary income, that's when you consider, might it be statutory income? Okay? Now, that's actually a change in the law. It used to be the case a long time ago that the tax law was structured such that the Commissioner of Taxation could go straight to arguing that a receipt was statutory income. You can't do that anymore. Okay? Now, there are other kinds of income under the tax law as well, right? It's only ordinary and statutory income that are assessable. But there is also exempt income and also non-assessable, non-exempt income. The main point, they're both not assessable, right? They're not income for tax purposes. In terms of the difference, well, we're not going to go into exempt income in this course, but I will mention it probably once more in the course at least. But the main practical implication of a receipt being exempt income is how it's taken into account in calculating a tax loss, right? Basically, in order to have a tax loss under Australian income tax law, you add together assessable income and exempt income, because exempt income is in fact an economic benefit, and it's only if your deductions exceed the sum of assessable income and exempt income, it's only then that the law will regard you as having incurred a tax loss. Now, I know you haven't dealt with everything you need to know to understand that point, so it will non-assessable, non-exempt income. Now that's a real mouthful. It's a complicated expression because the law is distinguishing it from exempt income. The main point is, for your purposes, it's not assessable. And in fact, you've gone through an example of it already last week. Can anyone think what it is? Non-assessable, non-exempt income, an example we've already done. Excellent. Temporary residence. Wonderful. Who said that? Over here somewhere in the middle? Yeah. Wonderful. Great work. The foreign sourced income of temporary residents is non-assessable, non-exempt income. Excellent. Okay. Now, we have these categories of assessable income, and it's conventional to break up the analysis like this, right? Now, they're not hard and fast categories in terms of a legal analysis, but it's conventional. And it makes some logical sense to analyse the cases in these categories, right? So we have income from personal services and employment, income from a business, income from property, right? And we will sort of follow that structure in terms of this lecture, and it'll continue into the following lecture, and that is the structure that your book adopts as well, okay? Now, in terms of some fundamental ideas to begin with, before we go into that analysis by types of income, the principle of constructive receipt, it is coming from judge-made law, the common law, and it's reflected in the legislation in section 654 and section 610(3). Now, really, it's a tax avoidance measure or an integrity measure. What this principle says is that if you direct a particular money, a payment, to be dealt with, right, on your behalf, then you are regarded in law as the owner of that money payment already. You are deemed to have derived that payment. It's yours, right? And so the context in which this issue can arise is, supposing with your salary, you want part of it sent to your spouse, right, your husband or wife, because your reason is they are on a lower marginal tax rate than you. And you're hoping that if your employer sends half your salary to your spouse, that as a family, you'll pay less tax. Is that going to work? No, it's not going to work at all. Well, it'll work in this sense. Yes, you can get the money sent to your spouse's account, but it's not going to change the tax outcome. It'll all be taxed in your hands at your marginal rates because of the principle of constructive receipt. The law will regard you as having derived all the money. Why? Because it's yours. And you've exercised control and authority over it, and you can't change that outcome by telling your employer to send part of it to your spouse. Now, what we're going to do is, now this bit is really important because we're going through the fundamental general principles of ordinary income, right? Now, there are certain prerequisites to a receipt being income. With the prerequisites, they are necessary but not sufficient. It's not enough for it to be income. Right. First prerequisite, it's got to be cash or cash convertible, right? Now, this rule, look, it is there at common law, but it has been significantly qualified by the Tax Act in Section 21 and 21A. It provides that the non-money component of the consideration for a transaction or a non-cash business benefit, they're treated as if they were cash, right? Now, the issue came up in Cook and Sheridan. Now here, the taxpayer received a holiday for selling drinks door to door. Now, let's make it interactive. I'm going to get you involved. So what do you think? Is that cash or cash convertible? Holiday. What do you think? Cash or cash convertible? You can just shout out answers. We don't have to call them answers. We'll just call them comments. What do you think? A holiday, cash or cash convertible? No, I mean, usually not. I mean, we'd need very special facts to tell us that, in that individual case, that you can somehow redeem it for cash. Holidays usually not. It's not cash or cash convertible, so it doesn't satisfy that fundamental prerequisite. So it can't be income, right? Now, in a business context, you've got to keep in mind Section 21 and 21A, because they do provide that, benefits received in a business context are deemed to be cash. So just keep that in mind. However, note this, sometimes they give you tips with your tutorial questions in the lecture for the following week. You actually have a situation in the game show context of that tutorial of where 21 and 21A don't apply in relation to some prizes that the people win in that tutorial problem. Okay. Now, because that first requirement, it's generally pretty easy to satisfy on the facts of most cases, right? The second prerequisite, the receipt has to represent a real gain, okay? A real economic gain. This is from the perspective of the recipient. Now, case illustration, Hochstrasser and Mays. Now, here, the employer compensated a person for the capital loss they made on their house, on selling their house, when they were required to move for work purposes. So do you think the person would regard that as a real gain? No? Yeah. Sorry? Not a gain. So I missed the first word you said. Compensation. Fantastic. Yes. That's the kind of language that the court used, right? Compensation. So not a real gain. And therefore not income. Okay? Now that case is at page 123 of your book, right? So when I give you page references, I'm referring to the 2019 book, but if you're managing with a previous edition, still write it down, because you might find it's not far off that number, okay? Okay. Now, what we've done are the prerequisites, necessary but not sufficient. So let's look at now what is sufficient. When do we know that a receipt is income? Okay, here is the defining principle of income according to tax concepts, right? This is it, okay? Because the prerequisites, they're often really easy to satisfy. Okay, the key principle is we need a connection or nexus. Nexus and connection mean the same thing, right? We need a connection with an earnings source. That is the nature of income according to tax concepts. I know your book has regularity, right? You know, looking at whether the payment is regular or periodic first, right? I think it has it first. Or it almost gives them seemingly equal importance. No. I think to come to the right conclusion, it's better to analyze it like this. The key principle is you need a connection with an earning source, right? It's only when you don't have a connection with an earning source that the regularity of the payment, right, and the fact that it's depended upon by the taxpayer may mean nonetheless that it's income. However, if you've got a nexus with an earning source, and we'll go through examples in a minute, and we even did in week 1, regularity really doesn't matter. Okay? So what do we mean by a nexus with an earning source? Most of the time, we're talking about a connection with a capital asset. Most of the time, we've got a receipt that flows from a capital asset. So if we consider a person's earning capacity, that is an asset, your earning capacity, right? That's the earning source, your ability to earn, your skills, your ability to exercise labor. Okay? And what's the flow? What's the receipt? It could be, salary, wages. Say it's a one-off payment that you receive for the work you do, right? Just a one-off contract job. There's a nexus with an earning source. It does not matter that it's not regular. That's why I say this is the fundamental concept. If you've got a connection with an earning source, regularity doesn't matter. What are further examples? Let's do this bit together because we went through it somewhat in week 1, and I think, it looked like you got it even in week 1. So let's go through some more examples. So give me more examples of capital asset, and we've got a flow, a receipt from that asset. The fruit and the tree analogy, right? The tree is the capital asset, the fruit is the income. More examples? Examples of rent, wonderful. Thank you. So rent is flowing from property and rent is income, absolutely, and the property is the capital asset. More. Dividends, fantastic. Dividends are from shares and the shares are the capital asset. That's the flow. Another one. Interest. Interest from the loan. The loan is the capital asset. The interest is the flow. It's income. Okay. Others could be royalties, right? Royalties from intellectual property like copyright, trademarks, patents, right? So I think we understand that. That's great because it's fundamental, right? Look, another important point about the nature of income, right, under this principle, and it's true of all the examples we gave, it must be possible to take that income, to take that flow of that receipt without destroying the asset. We can't be destroying the asset. If we're destroying the asset, that's a clue that we're not actually dealing with ordinary income. I think you'd be dealing with really some kind of capital gain transaction, right? So it's like, we can take the dividend from the share and the share is still there, right, to earn more dividends for us in the future. Okay. Now, if we look at the regularity principle, right, really you need that if you don't have a nexus with an earning source. And this is purely a tax concept, right? I say purely a tax concept because the idea of nexus with an earning source and the idea that that is income, that is actually a principle that you see even outside the law. You see it in economics, right? with the idea that a receipt can be income simply and only based on regularity and because it's expected and depended upon by the taxpayer, it's an invention of tax law. And the judges have concluded that, deciding tax cases. For instance, in the Kiley case, it was concluded that government-age pension is income. There's no nexus with an earnings source. You just get this payment from the government. But simply because it's regular, relied upon, it's considered income according to the tax law. So any regular payment from government would be, like, could be youth allowance payments, right? That's another example. Okay, now, a further general principle, it will only apply in some very specific situations, but it's important to know, it's the compensation principle, that compensation for a payment takes on the character of what it replaces. So it's a very useful point to know. So the authority, a good authority for it is Dixon's case. It's a High Court case from the 1950s. Now, in that case, where it was even though the case is decided in 1952, the events related to World War II. And there you had an employer, he told his employees that if you go and fight in the war and you enlist in the military effort, I will give you a top-up payment, which is the difference between your military salary and your salary working for me, right? The military salary is less. But he's saying, I'll give you a top-up payment, right? He wants to support the war effort. Now, what is the nature of that top-up payment? It's a compensation, right, for lost wages, salary. The judges held in this case, the nature of that compensation payment is it takes on the same character of what it's replacing. What is it replacing? It's replacing lost salary or wages. Salary and wages are income, therefore the top-up payment is income too. Okay? So that case is at page 128 of your book. Now, what we have done, actually, we've done a lot already. It hasn't taken us long, but in terms of what we've covered the fundamental principles. Now, I will ask, okay, no private conversations, right? Because I'm very glad you're here. Please keep coming, but private conversations distract me, and I'm sure they distract other people, your classmates, okay? So we've covered the fundamental principles. Now what we're going to do is go through analysing actually a lot of cases by these categories of income we've got. Personal exertion income, business income, property income. Okay, so let's start with personal exertion income, which is pretty important, and there's a lot of material on that in your book. Now, with personal exertion income, we are talking about income derived from your personal efforts or skill. Classic example, salary and wages, right? Employment income. Now, if we apply the general principle we've learned, right, about nexus with an earning source to this context, what we're looking for is a connection between the receipt of the payment, right, and a service. We want to be able, in order to conclude that that receipt is income, it needs to be a reward for services, right? So we're looking for that connection. Let's have a look at some cases. The cases we will look at are not going to be easy cases mostly. We're not dealing with the most straightforward scenarios here, right? We're dealing with trickier cases. So what we're going to do is firstly distinguish receipts that can be regarded as a reward for a service from personal gifts, right? So the question is, can we regard the payment in these cases as being for a service? If it's a payment for a service, then it's going to be personal exertion income, it'll have a nexus with an earning source, it'll be ordinary income and assessable income. If there's no sufficient connection with a service and the payment is primarily motivated by, for example, friendship or a personal relationship, it could be a gift. What is the tax consequence of a gift? Okay, I'm going to ask the two people at the back to answer this question, right? Okay. I'm really glad you're here, but we can't have private conversations if I'm speaking, or sometimes it could be one of you speaking. Okay. So let's have a look at Brown and FCT. So here what you had is that the taxpayer Brown received a beachfront apartment, right? Valued at $1 million, right? From, he said, his friend, right? And he didn't have to pay anything, right? So he got this beachfront apartment valued at $1 million, and he claimed it's a gift, right? Now, when we look at the facts, right, what do we see about the background? Well, it turned out that Brown had received this beachfront apartment from a property developer, right? Yes, it's true this property developer was his friend, but note, he's a property developer. Now, further crucial fact, Brown, the taxpayer who got this beachfront apartment from the property developer, had actually introduced the property developer to the purchaser that bought up the properties in this property development, right? And so what's the Commissioner of Taxation's argument? That receipt of this beachfront apartment from the property developer to Brown is actually a form of payment for the fact that Brown was very useful to the property developer by introducing the property developer to the purchaser that would buy up properties in that development. Right. So, conclusion, this beachfront apartment was in fact a reward for a service when we look at the facts. It's not a gift, right? And it's actually very hard, I think, in Australia, if you see persons that are not even in a family relationship and there's a transfer of property, to argue that it's a gift, it will be very, very hard, right? The idea that it's just a gift for the sake of friendship, you know. And when we look at the facts, we see that it's a form of payback, right? So their conclusion, it is income, ordinary income. And Brown would have to pay tax on the value of the apartment. So that case is at page 139 of your book. Now let's have a look at the next case, Scott. This is a very famous case. It's a High Court case. Now, here the taxpayer was Scott. He was a lawyer, and the important background facts, Scott was both the lawyer and a close personal friend of the Freestone family. Scott was very good friends with Mr. Freestone. And now what happened? Mr. Freestone died. There was legal work involved in administering his estate. The Freestones were a wealthy family, and there was a lot of work involved in administering that estate. And Scott did some very, very valuable work in connection with the estate. He did the work to lift restrictive covenants of large parcel of land so that it could be subdivided. When you are able to subdivide land, right, you can often unlock the value of the land, right, sell it in smaller parcels. So he did this valuable work in connection with the estate. Now, he charged Mrs. Freestone, right, his normal bill, which was, well, it's just according to his standard rates. And now, what Mrs. Freestone did was, she said, look, in addition to paying your bill, I am going to, she called it a gift, I'm going to make a gift to you of £10,000, right? Now, an important fact, Scott was fully remunerated apart from this £10,000 additional payment. Now, the question for the High Court, and you can think about it too, this additional £10,000, is it a reward for services? Is it part of that, right? Because he has done legal work, right, for Mrs. Freestone in administering Mr. Freestone's estate, or is it a gift? So, in terms of considerations to look at, the High Court said in this case we look at whether there's a prior relationship between the parties before the payment is made. You know, what sort of relationship have they had? Are they friends? How close is the relationship? If there's a personal relationship, that could suggest that it's a gift. A further consideration, is the payment expected or not? If it's not expected at all, then that suggests it's a gift. And also you do look at, well, what do the parties really think about this? Do they regard it as a gift? So what do you think on with respect to Scott's case? Do you think it's a reward for services or a gift? We're talking only about the additional £10,000. It's okay if you're not sure, because I think many of the cases we're doing are they've got competing arguments. So what do you think? I think I heard some people say things, but can we have someone say it again, what they thought? Reward? Some people are saying reward? Yeah? Are some people saying gift as well? Gift, yep. It's, look, I think we've got two views here, right? Okay, that's fine. The court held that it's a gift, right? So let's look at the important factors, it's what I went through, but let's just summarize, okay? But it's okay if you thought it was a reward for services. This is not an easy case, right? Because he is doing work, right? He's doing the important legal work. But what the court was influenced by was, and note this point, he is fully remunerated. She pays his bill, right? He's fully remunerated. This is an additional payment. It's not expected, and we do have the prior relationship, right? A prior relationship of friendship. And those are the most important factors, but a further factor is, now this wouldn't be as important as what I've just given you, but a further factor is that both parties regarded it as a gift. Okay? Okay, now let us distinguish windfall gains. Now, prizes, chance winnings, where it's mainly a product of luck rather than any skill, general rule, it's not ordinary income. Okay, so in general, gambling winnings at casinos, not ordinary income, right? Lotteries, general rule, it's not ordinary income, but sometimes you could have state legislation which charges a tax on lottery winnings, but it's not income according to ordinary concepts, right? Now, note though, in some cases where you see someone receive a prize, it may be treated as income if they're getting the prize because they are excelling at the job they do, or they're excelling at a particular service, right? So you have to look at the facts and see why are they getting the prize. So in Kelly's case, you had a professional football player. He received a $20,000 prize from a TV station, Channel 7, for being his league's best and fairest player. Now, the prize was held to be income because, why did he get it? He got it because he was considered excellent at his occupation, and his occupation was being a football player. It wasn't luck, you know, the way a lottery is. Okay, that's at page 148 of your book. Right, now we are going to distinguish personal exertion income from capital receipts. Okay, this can be a little bit tricky, but the principle is that if a person is being paid something, being paid some money to not do something, this is the key point, to not do something, then the payment is likely to be treated as capital, not income. So receiving a payment for agreeing not to do what you're entitled to do, right? If you receive a payment as per, you know, the Higgs and Olivier case, for agreeing with someone not to work in your profession for a period, there the famous actor, Laurence Olivier, agreed to not work in his profession, not to act or direct a film or to produce a film for a period of 18 months, and he was paid a large sum of money by a film studio for that. Is that income? Well, if it's truly a payment for not doing what you're entitled to, it is treated in the law as a capital receipt, not income, right? It's not a reward for services, is it? Because you're not performing a service. You're doing nothing, okay? I mean, it's a bit of a, you might think it's a bit of a strange case why he was paid to not do anything for 18 months. Well, you know, the film studio who he was contracted to thought that, well, one of the films that he had starred in was a disaster at the box office, and they thought it's best for his career if he didn't do anything for a while, right? That was the idea behind it. Now, an Australian case, so that Laurence Olivier case is actually an English case. An Australian case, FCT and Voita, illustrates the same principle. Here you had a football player. He was in the South Australian League, right? He received a payment of $10,000 from the North Melbourne Football Club for his promise that if he should ever play in the state of Victoria, where Melbourne is, he would only play for North Melbourne. So he is getting a payment for a restriction on his freedom, right? It's really a contingent restriction. If he should ever come to Victoria, he agrees not to play for any other club, which is his entitlement, right? So he's agreeing not to do something. If he ever comes to Victoria, again, it's a capital receipt. It's not a payment that's rewarding him for services. It's really paying him for a restriction on his freedom. If that's the case, it's a capital payment, not ordinary income. Now, moving on to non-disclosure payments, right? Now, it's illustrated by Heppel's case, which is in your book at page 153. And in fact, those other cases are at page 153 too. Now, in the Heppel's case, the taxpayer received a payment of $40,000 on his retirement, right, for agreeing not to disclose, not to reveal secrets of his employer. What is the nature of that payment? Now, it's very important, if you're talking about non-disclosure payments, to note when during the employment contract it is given. Here it's given at the end, right? It happens at retirement. If you see an employer giving a payment to someone at retirement, right, for agreeing not to do something, then it's likely to be capital, as it was here. However, and this will be a variation, right, in the tutorial question, that if a payment is made during the life of the employment contract for agreeing not to disclose secrets of the employer, very likely it'll be a different analysis. Because during the life of an employment contract, the employee is performing services, and it's very hard to disentangle what is, it's very hard to say it's not a payment for services, for what the employee is doing. Because the thing is, in a lot of employment contracts, you have an obligation while you're an employee to not reveal secrets of your employer anyway, right? So it's very hard not to see it as part of the overall remuneration package if it's during the life of the employment contract. Okay, so let's move on. We're still distinguishing capital receipts, right, from personal exertion income. Now, payments for giving up employee entitlements. This is the AAT case. Now, here you had employees of Shell. Their entitlement to rostered days off was unilaterally confiscated, that is, taken away by the employer. And they received a compensation payment, right? What is the nature of that, right? It's held to be capital in nature, because it's not a payment for a service, right? It's a payment for taking away a person's rights, right? That's capital in nature. And then a similar case, which you can look at, Bennett and FCT, that's in your book at page 152. There you had a managing director who gave up certain control rights in the company, and he was compensated, and that was held to be capital. Now, I want to discuss briefly with you the case of Brent and FCT, right? It's an interesting case. Now, you could have cases where, it may appear at first instance that the taxpayer is receiving a payment for agreeing not to do something. But then, as in Brent's case, you've really got to look close at the facts. Are they in fact performing a service? And if they are, then is it possible to regard the payment as actually for that service? Now, what you had in Brent's case was the wife of the great train robber, right? She had an interesting story to tell because her husband was this famous train robber and everyone was interested in her story. The newspapers were interested. Now, she reached sort of an exclusive rights agreement with one media outlet, Daily Telegraph, where she agreed, she promised that she would give her story exclusively only to them. And as part of the arrangement, as part of the contractual arrangement, she agreed to a series of interviews with that Daily Telegraph newspaper, right? She agreed to make herself available and she would tell her story to the journalists who would write the story, right? Now, she argued that the payment that she's receiving from the newspaper is capital, not income. Why? She argues, well, because I'm agreeing to give my story only to this newspaper, and I'm giving up my right to talk to other newspapers, right? So we have to think about this because, at least in terms of how she's presented the argument, we might think initially, okay, she's giving up some of her freedom here contractually. Okay, let's think about this. But then, look, she's actually providing a service as well. She's agreeing to the interviews. What did the court think? The court held here, we are dealing with income, not capital. Because they said fundamentally what's happening here is this person is agreeing to a series of interviews, agreeing to make themselves available, they're providing that service, the journalists are writing the story. The court held here, look, there's no transfer of any asset here, right? If there was a transfer of some kind of intellectual property, then we might accept the argument that it's capital, but this was important for the court. She had not written any story. There was nothing in relation to which copyright could be transferred, right? If she had actually written a story and there was copyright, then she could argue that the payment I'm receiving is for the transfer of my proprietary property rights in that story. She can't argue that. All she's doing is verbally telling her story to the journalists, right? And because of that, the court held fundamentally what's happening here is she's being paid for a service, okay, and it's income. Now, you can look at yourself. I'm not going to go into it in lectures. These are further illustrations. Reuters' case and Pickford's case at page 151 of your book, they're further illustrations of receipts where the courts have held that it's income. Okay. Now, let us have a 5-minute break, just 5 minutes, and then we will continue from this point, statutory income. So I think a couple of you have told me that the email about the tax clinic has come to you, right? So that is, you look, it's purely voluntary if you're interested. Like, I think I've mentioned it in these lectures that it's an initiative, you know, we've got the government support, right? ANU is one of 10 universities in Australia where we've received funding to have a tax clinic to help unrepresented taxpayers. As part of that, we're providing workshops. And actually the workshops on the 15th of August, that's when we're launching the tax clinic, it's going to be delivered by ATO representatives, completely free, and it's about, you know, lodging a tax return online and other useful information. So at least one person I know is already registered. So if you're interested, by all means, you know, free useful information, yeah, as part of our tax clinic. Okay, let's continue. 5 minutes are up. Okay, so what we're going to look at now is statutory income from services and employment. So we are still under this subheading personal exertion income, right? But we're looking at a statutory income provision relating to personal exertion income. It is Section 15(2) of the 97 Act, right? Now, what does it provide? It provides that all sorts of benefits that you receive in an employment context or for a service, they are regarded as statutory income, as income because of Section 15(2), and they will be assessable. So if we look at the list in Section 15(2), it refers to an allowance, gratuity, compensation, benefit, bonus, or premium that's given to the taxpayer directly or indirectly in relation to any employment or services, right, or given by the taxpayer. You see, it's really wide. But note, we still need that connection. We still need a connection, right? It must be directly or indirectly in relation to any employment or services. Now, the courts have said, well, the nexus or connection requirement is not as demanding as ordinary income, but it's still there. This is not that useful for us, right? To simply say it's not as demanding, but a connection is needed. What I would suggest is in quite tricky cases, right, if you are given any, and you're not sure whether there's enough of a connection with a service, then I would say argue Section 15(2) as well. Because the courts have said whatever nexus or connection requirement exists for ordinary income, the connection here, while it exists, is not as demanding. Why it's frustrating, when we're going to go to two cases now, is that whilst we do have cases on it, these cases, right, were decided under the old equivalent provision, and the equivalent provision, Section 26E of the 36 Act, it had the same wording, but there was an important feature of the law back then that the Commissioner could go straight to arguing the statutory income provision without first arguing that it's ordinary income and common law. And so, for instance, in Smith's case, we don't actually have a court ruling of whether it was ordinary income or not, right? But let's have a look at these cases, right? They were specifically about, is this statutory income here? And note, right, just flicking back, just note that for 15.2, it's not necessary that the benefit be cash or convertible to cash, okay, in order to be statutory income under this provision. Now, let's have a look at two cases, Smith and FCT and Payne's case. In Smith's case, Westpac introduced an incentive scheme for its employees. It wanted its employees to be more highly educated in relevant courses that would improve their productivity, effectiveness, efficiency at work, banking and finance related courses, accounting courses. This was case was heard in 87, where at that time a lot of people working at Westpac would not have had university qualifications, right? Now, and it wanted its employees to be more highly educated in relevant courses, and it agreed to pay them, make a payment, right, a financial payment upon successful completion of any subject, any course, and also a further payment on successful completion of the whole degree. And these payments could not be regarded as compensation, as simply compensation for tuition fees, because at that time, for domestic students, there were no tuition fees, right? They were pure financial gains. So what is the court ruling here? Are these incentive payments, are they income? Now, as I said, how the law was structured then, the Commissioner could argue to the court straight away it's statutory income without considering ordinary income even. What was the court's conclusion? Yes, it's statutory income. Why? Well, definitely we've got a benefit with incentive payment, no doubt about it, that it's a benefit. Is it sufficiently connected to employment? That's the key issue. Look, I suppose it makes some sense for even today that you might want to argue the statutory provision, statutory income rather than ordinary income, because this is not some straightforward case of, of a payment, very clearly and definitely being for a service, right? Here we're talking about an incentive payment for a subject, for successfully completing subjects and for a whole degree, and the purpose of that is to improve employee productivity. But for the purposes of the statutory income test, that is enough. There is a connection there, right? Because what is Westpac's motivation, right? It's giving these employees these payments so that they will be more highly educated so they can do better at their job. That's the connection, right? And that's enough, okay? So a yes there, it's statutory income. Payne's case, right, so this is an interesting case. You'll see it several times in your book for different points. Here you had an employee of an accounting firm. She had done a lot of work-related travel. She accumulated frequent flyer points as a result of doing a lot of work-related travel. And the question that arose for the court, these frequent flyer points that she accumulated as a result of work-related travel, is that income? Is that statutory income? Have we got enough of a connection with her employment, with services she's performing for her employer? Yeah, I think I'm getting people saying, no. The court agreed with you. No. And I think it's good we've got that result, because at least we've got a case where, yes, it's enough for Smith, and I think we can see the connection there. You know, the payment is to produce staff that are going to be more productive. Here, it's purely incidental to the work. Yes, it's true that she got it as a result of work-related travel, but that's the only connection. And the frequent flyer points, right, there's no direct connection with how good she is as an employee. There's no direct connection between frequent flyer points and how well she's doing her job, is there? And as the court put it, this is not a reward for services, this is a reward for flying with Qantas. Okay? So no for Payne's case. Right. Now let's go to business income. Okay, so going through our subheadings here under assessable income, we've looked at personal exertion income, now going to business income. Now, first we'll look at financial gains which can be regarded as ordinary business proceeds, which is a relatively simple case, and then we'll go to the more complex and probably more interesting area of gains arising out of extraordinary or isolated transactions, and can they be income, and when will they be income? Okay, so now firstly looking at ordinary business proceeds. Okay, let's take sales revenue for a business, right? Sales revenue, what you're familiar with in accounting, that is also assessable income for tax purposes. It may not be exactly the same number because there are differences between tax and accounting concepts, but conceptually it's the same. And approximately that accounting figure of sales revenue will be subject to some adjustments, right, will be also assessable income for tax purposes, right? That's ordinary business proceeds. Now, what is ordinary business proceeds will be very case specific. It depends on what the business does. So if we're talking about, and this is coming up in the next slide, right? If we're talking about a business where what it does is selling children's toys, for example, right? And it sells the land on which it has a factory which makes these children's toys, right? Is that an ordinary business proceed? If as a business what you do is make and sell children's toys, and you have a transaction where you decide that, say, you don't need one of your factories, say you think you can consolidate, and so you're selling that factory and the land, and you make a profit on that transaction. Is that an ordinary business proceed? If what you do is make and sell children's toys, selling the land, an ordinary business proceed? No, it's an isolated transaction, and any profit would be a capital gain. Okay, so flicking back, right? This talks about this capital versus income distinction, yeah? But if you're a land developer and your business is to buy and sell land and make profits, then if you sell land and make a profit, that is an ordinary business proceed. So it depends on what you do. Okay. Now, this is the benefit of coming to lectures, because not only do I tell you what's really important to know for exam purposes, but I also tell you about areas where it's just for your information and where you can just skim the book. You don't have to read it in a lot of detail. Your book in Chapter 8 has immense detail about identifying when someone can be regarded as being in business. I don't think you need all that detail about identifying when a business exists. I think you can skim it because I don't think it's hard. I think it's just important to have a sense of the factors and to get a feel for it. I think it's enough if you understand this slide. So, I mean, the reason we're trying to work out when someone is in business is, if we know they're in business, then we would say ordinary business proceeds, that's assessable income, okay? So to work out whether you've got a business, you look at whether the person has an intention to make profits, right? Profit-making intention, that signals a business. You look at, now this is very important, the scale, magnitude, and regularity of the activities that are undertaken. If it's a very commercial and systematic approach, that suggests there's a business. You know, the undertaking of risk suggests there's a business, right? If you take out a loan, right, that's risky. If you've got employees, that's a really strong signal, pretty much 100% that you've got a business if you're hiring employees, right? So case illustrations, FCT and Walker and Thomas's case, this is at page 239 and 240 of your book. In both these cases, the court held that the taxpayer was in business. And they are useful illustrations because they show you that sometimes even fairly small operations can be regarded as a business, right? If they're undertaken with an intention to make profit and using a commercial and systematic approach, which it was in both cases, right? In one case, you had a real estate agent operating an Angora goats business, and in another case, so that's Walker, and then in another case, Thomas's case, you had a lawyer who was held to be in the business of primary production, also growing macadamia nut trees and avocados, and it was really because of the commercial systematic approach, and he was growing it on a scale much more than would be needed for private purposes. Okay, you can look at that yourself in your book. Now, even with the matter of ordinary business proceeds, you'll get some cases that are straightforward. Like I introduced something that's fundamental but straightforward as well, with telling you that sales revenue is assessable income, right? But even under this topic of ordinary business proceeds, there are some instances where you'll have a receipt where it's not absolutely in the centre of what's an ordinary business proceed, but it's still sort of good enough or happens often enough that it is, right? So let's have a look at some cases. Now, in the first case, which is FCT and Merv Brown, actually that's a case where the court held, well, no, it's not an ordinary business proceed, right? But that was the issue. So now here what you had was the taxpayer, their normal business, the court analysed as being purchasing and selling clothing, right? That's their business. Now, the specific issue was in the context of restructuring their business and abandoning certain unprofitable lines of clothing, this clothing wholesaler sold certain import quotas that they had, right? And they made a profit on that. So the specific issue is the sale of those import quotas, is that an ordinary business proceed? And hopefully we can see, well, that's not a day-to-day or even month-to-month or perhaps even year-to-year transaction. That's really unusual. And that it has arisen in the context of the restructure of the business. It's not in the normal course of business, right? Selling these import quotas, and therefore held to be a capital receipt, so not ordinary income. Now we'll go to the next two cases, right? Now, in both these cases, the court held, yes, it's ordinary income. It falls within the concept of an ordinary business proceed, despite that the receipts in question are not utterly straightforward to analyse. It's not like the what I opened with sales revenue example, right? So let's have a look. In the Memorex case, what you had was the taxpayer operated a business of selling and leasing computer equipment, right? Now, as part of this business, from time to time, right, it sold what's called ex-lease equipment, right? So what it means is, like, most of the time it's selling new equipment, and then it would lease some computer equipment, but then sometimes what it would do is it's got computers where they've been leased, say, for 3-4 years, and they've still got some useful life, but the company the taxpayer doesn't want to lease them out anymore, but it's prepared to just sell them, probably at quite a low price, right? The sale of formerly leased computers. Now, is that an ordinary business proceed? Court said yes. Look, it may not be a major part of your revenue or something that happens, really often, but it's still part of your business, something you do from time to time, and I can accept that. That is still part of ordinary business proceeds. Okay. Now, so just look around page 254 to 255 of your book on the cases on this slide. Now, the GP International Pipe Coaters and FCT case, actually I can pretty easily accept that is ordinary income. What you had there was the taxpayer was the successful tenderer under a pipe coating project. And so it was successful in getting this contract from a government entity, right? And that government entity was the State Electricity Commission of Western Australia, right? And now, under that contract, so the taxpayer is getting remuneration, right, from the government, to coat these pipes. And part of the contract terms involves the taxpayer constructing a facility where this coating of pipes would occur. And towards construction costs, the taxpayer got $5 million from the government. Now, the issue is that $5 million, is it income? Right? Now, actually, I can pretty readily say yes to that. Actually, I think it's even more straightforward than Memorex. But even though, whatever the taxpayer may argue, what's really happening here is that $5 million is really part of the remuneration or overall success fee for being, for getting the contract. It's part of the remuneration under the contract. And really, it's sort of a side point, I think, virtually, that you're going to use that to satisfy the contract terms and to build a facility. You have to build a facility, right? But so it's using part of the remuneration to build the facility, right? Key point, it's part of the overall success fee, that $5 million for the pipe coating project. So yes, it's income. All right, now we're getting on to this very interesting and important topic, subtopic, right? In a business context, we're looking at isolated and extraordinary transactions and when might receipts that are the result of extraordinary transactions be regarded as ordinary income under the tax law. The leading case is Meyer, okay? And we just call it Meyer. It's a very well-known case. And we talk about Meyer Strand 1, Meyer Strand 2. Now, they are actually independent and alternative tests, right? That you can capture a receipt as assessable income under either Meyer Strand 1 or Meyer Strand 2, right? It's not a case of, satisfying both or anything like that. They're alternatives, right? And you'll see that Meyer Strand 2, it will really apply in a very narrow, specific scenario, so it's easy to identify. Now, to give you the big picture here, there's actually three ways in which a receipt from an extraordinary transaction can be captured as ordinary income, right? Maya 1, Maya 2, and under the Whitford's Beach test, right? And under the Whitford's Beach test, a receipt from an isolated event, an isolated activity, will be income if that activity takes on the features of a business of itself. Now, in problems, there's often an overlap, and they both could apply, between Maya 1 and the Whitford's Beach test, right? So often on the same set of facts, you'll consider both Maya 1 and Whitford's Beach, whereas Maya Strand 2 is very specific, right, where it applies. So let's have a look at the Maya case. What happened, right? Take a look at the facts yourself, right? It may seem a little bit strange, and you might wonder, I mean, the natural thing to wonder is, what are the economic incentives here? Why is Maya doing what it's doing? What's the purpose of this transaction, right? So Maya, it's this retail store, right? You may be familiar with it, right? It's been around in Australia for a very, very long time. So now what happened on 6 March 1981, Maya lent $80 million to its subsidiary, Maya Finance, right? A shelf company that it had bought recently, right? Now, the thing you've got to keep in mind, right? I mean, because apart from knowing the tax principle, you know, of course you want to understand the sense of this. Why are they doing this, right? Because also this is an internal transaction within the group, right? So lending $80 million to its subsidiary, it doesn't actually have an economic consequence. It's all within the group, right? So what will have an economic consequence? Let's see. Let's read the story, right? Now, so under the loan agreement between Maya Finance and Maya, there's interest payable, right, from Maya Finance to Maya of 12.5%, and the total interest payable over around a 7-year period is $72 million, right? Now, at the time the loan was made, Maya intended to sell the right to interest on the loan to Citicorp, which is a finance and investment company. For a moment, right, let's just briefly consider the economic incentives, right, because we want to see the sense of things, right, not just purely understand the tax principle. Well, I think what's happened here is that the Maya company has decided that it needs a lump sum amount of cash, a lot, fast, right now. How is it going to get that? That's why it has entered into this agreement with its subsidiary, to generate and create a right of interest under that agreement, and then what it's doing is selling that right of interest to the finance company Citicorp, and Citicorp is paying Maya, right, instantly $45 million. So the economic incentive is that Maya wants $45 million now. How is it going to get it? It's creating this agreement in its group of a loan agreement, which has a right to interest, and it's selling that right to interest. Now, the Maya group will have that liability. The right to interest now belongs to Citicorp, and it will have to pay $72 million over 7 years. But Maya has judged that that is worth it for them, right? They're willing to pay that, right, over 7 years in order to get $45 million now. The tax question now. Was the receipt of $45 million to Maya of an income nature. Is it income or capital? Maya is arguing it's capital. It doesn't want to be taxed on it. Right? Now, these days, what you have to keep in mind with all these transactions is the effect of capital gains tax provisions. You know, at the time these events happened, there was no CGT, there was no capital gains tax. Right. Now, the High Court, and it is really quite a tricky case, and the judgment is not easy to understand, and I think your book makes that point, right? The court held the $45 million lump sum, it is income, right? Now, why is it income? Now, subsequently, people have analysed the High Court's reasons and broken up the reasoning into 3 elements. And you need all 3 elements satisfied, right, to conclude the receipt is income under this Maya-Strand 1 test, okay? Now, also just note the quote, the actual words of the judges, right? And they're saying a receipt, it could be income even though it arises out of an isolated business transaction, right? If it's entered into with the purpose of making profit, right? And so if we look at the elements, right, we need a business or commercial transaction. Well, we certainly had that in the Maya case. Is it entered into with the purpose of making a profit, right? Well, absolutely yes, right? Again, Maya wants that $45 million from Citicorp, so that is its purpose, right? Is profit is made by means consistent with the original intention of the taxpayer at the time of entering into the relevant transaction. Well, here what you do is you consider what is the transaction and when did it start. Well, it's okay, quite okay to analyse it here because everything went according to plan. But basically what had happened is Maya had formulated the idea that it wanted to get $45 million from Citicorp. Then it thought, how are we going to do it, right? And then it created the loan agreement and sold the right to interest. So that profit, that $45 million gain, right, it is made consistently with the intention of Maya at the start of this little scenario where it, you know, creates the shelf company and the loan agreement, because all along that was its plan and things went according to plan. I think it's useful to really contrast the Westfield case with this, because that's an illustration where things don't go according to plan, okay? So all those 3 elements are satisfied. That's called first strand of Maya, okay? And it's income. Now, it's useful now to go straight actually to the second bullet point here in the Westfield case. Right, now what happened here was we have the shopping centre developer manager Westfield, and in this particular case it was thinking of going into business with AMP, right? And it was considering jointly designing, constructing, leasing and managing a shopping centre with AMP. And Westfield had bought the land, right, that was intended to be where the land upon which they would operate the joint venture. But things didn't go according to plan, and what happened was it ended up selling this land to AMP instead of the two developing, constructing a shopping centre together. Now, it made a profit on that sale of the land to AMP, and the question for the court that profit, that gain on the sale of the land, is that income or is it a capital gain? Anyone want to volunteer? What is the nature of the gain there? Income or capital? Capital gain, yes. And I like the case because I think it's a pretty clear-cut case of a capital gain, and then it's a nice contrast with Maya where everything went according to plan. We see clearly from these facts that things don't go according to plan. This is a surprise gain, and it's a surprise in the sense of the gain is not made in the way intended. Yes, Westfield had a profit-making intention, but it was not an intention to profit from selling land to AMP. They were intending to make profits through operating a joint venture, right? So if we go back to the elements of Maya Strand 1, right? So in the Westfield case, yes, you do have a business or commercial transaction. Entered into with the purpose of making profit? Yes, I mean, it entered into that, it bought the land certainly with the purpose of making profit, but the idea was to make profits through the joint venture with AMP. Now 3, profit is made by means consistent with the original intention of the taxpayer at the time of entering into the relevant transaction. That is no, because as I said, it was supposed to be profits from operating a joint venture, not the capital gain on the land to AMP. That was just something that happened. That was not intended. It's when things didn't go according to plan. So that is a good case to contrast. Now, Westfield is discussed at page 268 to 269 of your book. Now, another case which you can just note, I actually don't think it's that important, it's just an illustration, whereas Westfield I would say is important. In Cooling's case, you had the taxpayer who was a commercial tenant receiving a lease incentive payment, right, for taking up a lease. This happens to businesses, right, that for taking up a lease of office space, they may get a payment, an inducement from the landlord to take it. Look, as residential tenants, we never get it. We never get incentive payments from landlords to take up a lease, but businesses do from time to time. And the court held in the Cooling case that that lease incentive payment was ordinary income, actually on 2 independent bases. One, that it could be regarded as an ordinary business proceed because this business from time to time did receive lease incentive payments. The further basis was under Maya Strand 1, that you had a business or commercial transaction, that one of the reasons of the taxpayer in taking up the lease was just one of the reasons, and that was good enough, was to receive that lease incentive payment, right? And then and it was expected, right? And so elements 2 and 3 satisfied, okay? Now, let's go to Maya Strand 2, right? Now, this is a further basis that the High Court gave in Maya for why the particular gain, the $45 million, is income. And it's really a completely independent basis, right? It's actually quite a clean, neat principle, right? And it relates to that compensatory principle we learnt about earlier, that, that a compensatory payment takes on the nature of whatever it's replacing. Now, the court held as a further basis for the conclusion in Maya that the $45 million lump sum payment is income because what it is replacing is a right to a future income stream, interest, which would be income when received, right? So it's the compensatory principle. If you are getting a lump sum payment and it is replacing right, or in compensation for a future income stream, right, a future stream of payments which would be undoubtedly income when received, right, in which interest is, then the lump sum payment itself is income, right? So that is Maya Strand 2, an alternative basis, alternative, note that, for the conclusion in Maya. Now, it was applied in the Henry Jones case, right? Now, what you had in Henry Jones was the taxpayer, they made jam, right? Well, apart from making jam, they had this canned fruit business, and they really wanted to sell it to someone. And they were negotiating with SBC and Admona, two companies, but SBC and Admona, they weren't interested in buying the canned fruit business altogether, which was Henry Jones' ideal outcome. However, these two companies, SBC and Admona, they did agree to license the trademarks of the canned fruit business. They entered into a 10-year license agreement. And under this license agreement, Henry Jones, the taxpayer, would receive royalties from them. Now, then what does Henry Jones do? Well, what it does is it enters into a transaction with Citicorp again, the finance and investment company. It sells its right to royalties under that agreement with SBC and Admona to Citicorp in return for a lump sum payment of $7.5 million. And the question for the court, was the payment of an income nature? Can we apply what I've told you about Maya 2 to the facts there? What do you think? $7.5 million? Think about, what is it replacing? Sorry? Yes, I heard something. What is it replacing, the $7.5 million? Royalties, right? Are royalties income? Yes, right? It's replacing an income stream. So, or it's compensating for the sale of an income stream. So it is income of itself. Right. Now, let's go to this case, Whitford's Beach, right? Now, yeah, look, spend time in your book reading that case, right? Whereas, look, Maya is really important, but I think if you understand what we've gone through in the lecture, that's sufficient, right? With Whitford's Beach, I do think it's quite useful to have a look even in more detail about the facts and really get a sense of why the court came to the conclusion that it did, right? So what was the scenario there? Well, there's a story to it, that you had initially 3 fishermen who had incorporated this company, Whitford's Beach, right? And initially the purpose of the fishermen, right? So they incorporated the company and they're the shareholders initially. Their purpose is recreational. They're not a business, not at the start of the story, right? They have, this company is to facilitate their recreational use of part of the beach. They have a fishing shack on this beach and they own some land right through the company, right? And it's recreational, the purpose. It's to fish. It's to enjoy the beach. Okay. Then years later, what happens, right? The fishermen, they sell their shares in the company to a property developer, right? At this moment, as one of the judges said, the purpose of the company is transformed. It's transformed from a recreational purpose, which it had at the beginning, right, to a profit-making business purpose. Now the shares have been sold to a property developer, and the property developer changes the constitution of the company, right, to state that the company's purpose is land development, right? Then what happens? Substantial redevelopment, right? And it's actually undertaken on a massive scale, as the judges said. Just noting some of the words from the judgment. There is, in terms of the work done, there was laying out and construction of roads, provision for parklands, services and other improvements. So it was a large area of land involved. It was subdivided to be sold in smaller parcels and on a very large scale involving, roads, provision for parklands, right? Now, and then the property developer, it sells, right, land in the development, and the question for the court, these gains that the property developer is making, is it capital in nature or ordinary income? What do you think? Sort of, what's your intuitive feel? Just based on general principles. We've got a property developer here now, selling the land that it's developed extensively. What do you think? Income? Ordinary income. Yes, yes. Now, how the court put it was this, you can regard this activity as being a business of itself, right? I mean, look, certainly the property developer, it's in business, but why we analyse it in terms of this is a business of itself is it mattered to the analysis of this case that only the shares were sold to the property developer, so that initially in the life of this company, it doesn't have a business purpose, right? It was recreational. That's why we're focusing so much on this particular activity. And what the court held was this development, it's undertaken on such a large scale that it's a business of itself. So that even if you, the company, are not normally in business, or you weren't in business at the start of your life, if you, in relation to even one transaction, undertake it on such a massive scale that you look like you're a business, even for a once-off transaction, then the profits you make from that will be treated as ordinary income. So that's why your books